Hey everyone, let's jump right into this explainer because we've got a seriously fascinating situation unfolding in the semiconductor space right now. We're looking at Vishay Intertechnology. Now, if you follow the industry, you know Vishay is a foundational player. They manufacture the discrete semiconductors and passive electronic components that are literally the building blocks for almost all of our modern electronic devices. And they just dropped their Q1 2026 earnings. So, the central tension we're going to unpack today is this massive disconnect between Vishay's undisputed internal momentum, which was a huge Q1 beat, and Wall Street's surprisingly cautious, even bearish outlook. It's basically a classic showdown of raw data fighting against market sentiment. To really set the stage, we have to start with this number, $839.2 million. That number shows you the sheer magnitude of Vishay's first quarter revenue beat. To put that into perspective, Wall Street analysts had estimated revenue to come in around $827.5 million, and Vishay's own internal guidance was sitting between $800 and $830 million. Well, they just blew past both of those conservative estimates. That $839.2 million represents a 17.3% year-over-year growth, and it actually marks their fourth consecutive quarter of sequential growth. For a cyclical industry like semiconductors, hitting this kind of top-line velocity is a massive indicator that they are squarely in the middle of a major demand upcycle. So, here is our roadmap for today. We're going to cover 1. The Q1 earnings surprise. 2. The Vishay 3.0 strategy. 3. Riding the megatrends. 4. Cash flow and dividends. And finally, 5. The Wall Street disconnect. All right, starting right off with Section 1. The Q1 earnings surprise. Because to understand the market's reaction, we first have to respect the raw data. Vishay didn't just meet expectations, they cleanly beat them across the board. We already talked about that massive revenue beat, but look down at the bottom line. GAAP earnings per share came in at 5 cents, just cruising past the 3-cent estimate. That is a 66.7% positive surprise. And their adjusted EBITDA hits $78 million compared to estimates of $67.36 million. That's a nearly 16% beat, achieving a 9.3% margin. This comprehensive financial outperformance is exactly why the stock saw a massive 14.5% surge immediately following the earnings release. And what's great is that this volume growth wasn't just in one niche. It was broad-based across both their semiconductor and passive component segments. Now, you might be wondering, is this growth actually sustainable? Well, to figure that out, we need to look at the book-to-bill ratio. This is an incredibly important metric in the manufacturing and semiconductor world. Essentially, it compares the amount of new product ordered to the product actually shipped out the door. Anything above 1.0 means you're getting orders faster than you can fulfill them. Vishay posted a massive overall ratio of 1.34 in Q1. Breaking that down, it was 1.47 for semiconductors and 1.23 for passive components. Because of this surging demand, their backlog increased 21% to a staggering $1.6 billion. That represents about 5.7 months of production runway just locked in and waiting. Moving on to Section 2, the Vishay 3.0 strategy and how they are scaling with customers. Because the crucial point here is understanding why they're succeeding right now. I absolutely love this quote from President and CEO Joel Smajakal. He confidently points out that their recent strategic shift is directly responsible for this Q1 beat. He's basically saying that the aggressive investments they made to expand capacity for high-growth, high-margin products mean that Vishay is now reliably scaling right alongside their customers. They aren't just sitting back and reacting to demand. They actually prepared for it. If we break down this Vishay 3.0 strategy, we can see it's a very deliberate framework. Their absolute top priority going forward is to increase their backlog turns. What that means in plain English is they want to convert that massive $1.6 billion backlog into actual shipped revenue much faster. By doing this, they maintain highly competitive lead times even as global consumption accelerates. Now, this kind of capacity expansion requires serious capital. They invested $273 million in 2025 alone, with 82% of that going directly toward high-growth product lines and wafer fab expansions. It's a strategy designed to ensure they fully participate in the market's current upcycle, rather than getting bottlenecked by their own production limits. But to understand why they did this, you have to look at the past. Historically, Vishay's cumulative 5-year total return has underperformed both the S&P 500 and, pretty notably, the Philadelphia Semiconductor Index. Over a 5-year historical view, Vishay saw its revenue grow at a pretty mediocre 3.8% compounded annual growth rate. They were lagging behind the semiconductor sector standard and totally missing out on the full upside of previous demand cycles. So, Vishay 3.0 is management's direct, aggressive response to make sure that historical underperformance doesn't happen again. Let's look at Section 3, riding the megatrends, specifically EVs and AI infrastructure. We need to explore exactly what's driving the market's massive appetite for Vishay's components today. Vishay has two major growth drivers working for them right now. On one side, automotive revenue rose 2.7% sequentially. That's being sustained by continuous electric vehicle ramp-ups and really strong OEM demand across the Americas and Europe. On the flip side, industrial power jumped 6.5% sequentially, and that is its fifth consecutive quarter of growth. That side is being driven by AI servers, smart grids, renewable energy, and massive power management projects. Think about it. As the electrification of transportation and industrial systems accelerates worldwide, the need for highly efficient power management components, like Vishay silicon carbide MOSFETs, is just skyrocketing. Okay, Section 4, cash flow and dividends, because it's one thing to talk about massive capacity expansions to meet AI and EV demand. It's another thing entirely to actually pay for it. So, here are the real-world cash flow realities. Because they are so aggressively investing in new factories and equipment for that Vishay 3.0 strategy, their free cash flow actually dropped into the negative. It came in at negative $46.9 million for the quarter. However, management views this as a totally necessary transition phase. And crucially, this is big. They are still maintaining a reliable 10-cent quarterly dividend. Thanks to a stockholder return policy they set up back in 2022, they're committed to returning at least 70% of free cash flow to investors. So even during this period of negative free cash flow driven by heavy capex, their strong cash reserves allow them to satisfy income investors without sacrificing their future growth. And that brings us to Section 5, arguably the most interesting part of this whole explainer, the Wall Street disconnect. Despite stellar execution and massive revenue beats, external Wall Street sentiment remains surprisingly cautious. To really understand this, let's establish our baseline. $37.23. That's the current trading price of the stock, following its massive post-earnings surge. The stock actually has incredible momentum right now. It's up over 156% year-to-date, reflecting the market's immediate reaction to that Q1 surprise. But here is the wild part. The analysts looking at this stock aren't nearly as optimistic as that year-to-date chart suggests. Look at this severe visual drop from the current price of around $37 down to a median analyst target of $34. That implies an 8.7% downside from current levels. You even have highly conservative estimates like Bank of America's $28 target, which implies a nearly 25% drop. Out of the top analysts tracked, the consensus is entirely neutral: one buy, one hold, one sell. So why the hesitation? Well, semiconductors are a highly cyclical industry. Some analysts clearly believe that this peak revenue growth is already fully priced into that $37 stock price, and they're just super wary of the inevitable cooldown that usually follows a big inventory buildup. So, to wrap up, I want to leave you with this final thought. We have a very clear tension here. On one hand, you have Vishay's undisputed internal momentum, a $1.6 billion backlog, a 1.34 book-to-bill ratio, and the success of the Vishay 3.0 capacity expansions, specifically targeting AI and EVs. On the other hand, you have Wall Street's stark caution, with median price targets predicting a pullback and real fears of cyclical peaks. Given all the data we've impacted today, how will you read the market's next move? Will Vishay's internal engine outpace those external doubts? Thanks so much for joining me for this explainer, and as always, keep exploring the numbers.